There's $4 trillion that are coming due of debt. A lot of people didn't make great decisions in 21, 22. So it's creating a lot of opportunity where you can find discounts of 20 to 45% on certain multifamily. Yeah. And the demand is still there. The demand's not going anywhere.
Welcome to the Heartland Multifamily Show, the shorter, more profitable path to multifamily ownership and investing.
So let's start there. Talk to me about, your experience, your decades of experience in working with family offices. I've read everything about what you've got out there, but talk to me a little bit about, and this can sound like maybe kind of a dumb question when I ask you this. Talk to me maybe about what it is that you do and what you're doing today in terms of your work with the Family Office Real Estate Institute and your work with with family offices.
Sure. So my whole focus is, and honestly, I figured out what I wanted to do, in my 40s, and I was like, real estate, which I love, and families. Mm-hmm. And, I think one of the biggest reasons is because it fascinates me on how some people have created their wealth. And there are things you would never guess in a million years, and that's everything from, I met somebody one time that, from Coca-Cola to, waste management, right? Mm-hmm. To plumbing. You don't realize it, to the berries. I don't know if you know Driscoll berries in the supermarket. And I was talking to Sheila Driscoll, and she's telling me that the story about her grandfather, and she just lit up, which is great. And so, how I fell into it, 95% of the people fall into a family office. And just back to something you just said about the understanding of what a family office is. Mm-hmm. First off, the number that we put it at is 250 million or more. And it's funny because somebody worth 100 million, you're like, they're only at ultra high net worth.
Right.
They're not, they're not that big, but 250 or more, which is greater. And the statistics around that wealth is that 70% will be lost by the second generation and 90% by the third generation. So the further it gets down the line, the harder it is for that money to stay. And there's a number of reasons for that, etc. But that's, and then the second thing to explain is it's the business of the family and not the family business. So everybody at some point in time should start to get things in order. That could be, you have your life insurance, you have your retirement plan, you have your, how you have to budget for how much you can spend, right? And so you sort of have your financial house in order, especially when you want to retire. Well, that's the same thing for very wealthy families, but you just start adding a lot of zeros to it. And so the complexity comes with that. And so it's a matter of, the business of the family. So that's things like, well, you have to put things in place so that if you want to maintain your legacy for long term, right, you need to get all the family members involved, and including even the kids, right, at some point in time. And I've seen some things that are really cool. But everybody has to know what's happening, what's the plan is. And if you want to maintain, and I think the Rockefellers have done a really good job, is maintaining who you are as a family, what you believe in, so that generations down the road, they have that same, the genes are the same, but also is the way that they look at things, right? And how
kind of their philosophy kind of moving forward is still kind of consistent with that. Okay.
Yeah, because it's like, what do we represent? What is who are we and what are we about? And so how are you going to make sure that 60 years from now it's still going in that direction? And so that's planning. Investments, there's two sides. especially with a family office, there's what I call the hard side, the soft side. The hard side, that's the investments, strictly investments. Soft side is things like governance, family councils, investment policy statements for the whole, how are they going to transition to the next gen. You do have estate planning, you do have tax planning, but just depending on the size of the family, they might even have the family office pay the bills or help with the jet or, send gifts. I mean, it's there just for the family. The office is there just for the family.
Got it. Yeah, a couple things regarding that. At what, when a family office approaches you, typically what stage are they in with what you kind of briefly covered there? Typically what stage are they in when they decide they want to contact DJ and start having a conversation?
They've already been, it's first, second gen, and they've already established for the most part. They might have an office already in place, and it's the family's money that they're investing and stuff like that. And so that's really where I would come and play. It's not before they sell the business, which is a great place to be positioned, but it's after the fact, and ideally in the first or second gen.
Yeah. How difficult, based with your experience, how difficult is it? And I heard the stats, but in the work that you've done, with family offices, how difficult is it for them to keep their, I think I use the word again, philosophy, investment philosophy, not only that, but kind of I'll just use the term family philosophy. How hard is it for them to keep moving forward with that? How hard have you seen that to be in your work with them?
Well, it depends. It depends if it depends if they put in governance in place, which are basically the rules and policies, right? If they have that in place or not. So you have to have that in place so that everybody's on the same page. If you don't, there could be mayhem, that starts happening.
Right.
Are you familiar with the Pritzkers?
Yes.
Okay, so I just got off the phone with one of the Pritzkers' office literally like an hour ago, and we were talking, and he started explaining how, everything was under one roof from a family office perspective, and then, people down in the younger generations were like, okay, we're supposed to have all this money, where is it? So they wanted to manage it themselves, their own portion, and they wanted to do their own thing. The Walmarts have done that same thing too, where they're starting to branch off, and the further you get away from who made the money, the harder it is to stay together, really.
Yeah.
And that's why if you don't have a game plan in place, you'll have no continuation.
Yeah. Yeah. I can see where a lot of, how do I want to say this, optimistic thinking can enter into this in terms of, oh, we've got it handled. We're a family. We're together on this. And then when you start talking about real money, which is what you're talking about, you mentioned $250 million or more, you start talking about that, I'd imagine the dynamics then really start to change quite a bit.
Well, what I've always said is everybody, all of us, you've had issues before, whether it's with your brother, your sister, your aunt, your uncle, your cousin, your grandparents, your parents. It just happens within the family at some point in time. Now start adding a ton of zeros after that. So that is just magnifies that significantly, right? So, and sometimes without the zeros, you're having, there's challenges or issues or infighting or whatever the case is. Once you start adding all that money, it just becomes something totally different.
Yeah. Yeah, I bet. How, I would imagine gaining the trust of a family office is not the easiest thing to do. But how are you, I guess I'll use the word positioning. That might not be the right word. How do you position yourself with family offices so there's that trust factor? Does it take a long time? Is there some immediate trust factor when the family offices start talking to you? Because I can imagine that might not be the easiest thing to obtain.
Well, that's the number one thing you have to obtain is trust, and people that try to raise money from families, the first thing out of their mouth is, here's my deal, and I want $5 or $10 million. That's one of the things at the Institute. I made point that 70% is about real estate, 30% is about different aspects of the family office, because there's so much that's going on that you have no idea. I mean, I was with one of my patriarchs in New York. This was a long time ago. And we were meeting with another one. And one said, "You have any kids?" He goes, "Yeah, I have a son." And the other guy goes, "Yeah, me too." And then my patriarch said, "Yeah, we don't get along too well." And then the other father said, "Yeah, same thing." And then I felt like I was a fly on the wall, right? And they start talking about the issues of what's going on in that family dynamics, because a lot of times money's given to the younger gen and they didn't have to earn. They didn't know how to earn it, but then they feel like, oh, it's easy money. It's here. They don't think about it, So I've seen $20 million go up somebody's nose before, with drugs and stuff like that. So, but trust is the number one thing. The way that I go about things, because we do have at Evergreen, we're a family office investment consortium, so we'll invest on behalf of a number of families. And when we're bringing in other families, and this is when I'd work for families too, if we were trying to, just put together a syndicate of sorts of families, I would meet them and get to know them a little bit and keep in touch. Then about 5-6 months down the road, "You ready for my pitch? Here's my pitch." I'm like, "Hey, it's DJ. How you doing?" "Good, good, good. What's going on?" I'll bring up something about the past. I said, "Hey, we're working on a deal. You want to take a look at it?" "Yeah." "Well, the door's open now. So now we can talk business, right? Because you said it's okay." And, I've known people for as long as 8 years that did nothing. And then they finally did something, right? So you meet a family, it could take a week, it could take, 8 years, right? So it just varies where they are in the process, plus how much liquidity do they have. And the biggest, I think, misnomer, and I made this same problem within the first 3 months, was I'm thinking to myself, okay, here's very wealthy people, they're very successful, they're smart, right? They super knowledgeable and all this other stuff. And I start talking about different parts of real estate. And what I realized is that they might know their business that they've been for 40 years, let's say chemicals, but they don't understand real estate, hedge funds, private equity, stocks, bonds. And if you think about it, VC, people spend their whole life not only in private equity, but healthcare private equity, and not just healthcare private equity, but mid-market private equity healthcare, right? And so you can't assume that they actually understand everything. And we had a course at the Institute one time when we had 3 billionaire families represented, and they all were asking what a cap rate is, and you wouldn't think, and that included their CIO. So you can't assume, a lot of times I'll ask, "Do you know that?" And it's hard because sometimes, you don't want to insult them, but you also want to make sure that they actually understand, because if they don't, they're gone, right? People don't invest in anything that they don't understand. The other thing too is that, so you're about to sell your business. and you've got 200 million coming in.
Mm-hmm.
Darren, who would you go to help with the money? Yourself.
Myself?
Yeah.
Oh, let's see. The first place would be a trusted advisor.
Okay.
You know, so that, and maybe that wouldn't necessarily be a financial advisor. Maybe it would be. So it'd be a trusted advisor in terms of, okay, I got a payday coming. Here it is. What the heck do I start doing with this money? What do I
Okay.
do with this money?
Okay.
And
remember, there's other, but there's all other things that I said that, well, there's also the family office structure, setting it up, how to set it up, the governance, putting in everything in place. It's not just the investments. You've got a lot more to deal with. And 95% of the people fall into the position that they're working with, because it's not who's the best, it's who do I trust, right? And they're just like that person, that the person you're talking about could have been an accountant. Well, guess what? He's been an accountant for 40 years, but he doesn't understand anything about family offices. He doesn't necessarily understand sophisticated tax planning to the level that you need it now, right? And also, the different investments and everything, right? So you run into, it's all based once again on trust, right? To handle and do I trust this person to help with what I'm trying to accomplish?
yeah, I mean, it's interesting that, well, first of all, it's not surprising that trust plays such a huge part in that. I don't think. And, to your point of, I'll use the word sophistication. My experience is with, and my experience is mainly with higher net worth folks, not ultra high, but higher net worth, for the most part, net worth folks. And I run into similar things where I remember early on, my expectation was they would pretty much know about most everything, especially when it comes to real estate, especially when it comes to multifamily, because a lot of people at least have some experience with it, maybe growing up, or maybe they live in an apartment, or maybe, there's at least maybe some experience there. But I'm finding that, I found that that's not necessarily the case. I think that's a really good point.
It's not at all. And you know what cost segregation is?
Yes.
Okay. They don't understand cost segregation. What is that? I mean, it's the majority of people. And so the other thing too, I think that goes along with what you're saying, people think that family offices, I don't know if you've ever heard this before, but some people call them institutional. Okay. So you've got a couple different types of pockets of money. You have the retail clients, which are the normal person might have a net worth of a couple $100,000, $300,000, $1 million, whatever. You then have the next level up, which they might have 10, 50, $100 million, 10 to 50 million maybe, right? And institutions have a box that they invest into. So they literally say, we're looking for XYZ. If you give me XYZ, I will look at your deal, right? And also, it's not their money. They're investing on behalf of pension plans and insurance companies and whatnot, right? So it's all analytically based. There's no emotion. Well, the family that has 100, 200, 300 plus $million, they're no different than that person that has 100, 200, $300,000. They're like, I may never see this again, especially that big. So I need to be very careful with where I put my money, and more importantly, who I put it with.
Right. I was thinking that I don't know if the word fiduciary is like the right term, but you're working on behalf of of a family office, and they're looking to you for some investment advice, or like you were talking before about, can I talk to you about a deal that I'm working on? How much pressure, a guy like you in your position, how much pressure are you feeling in terms of, I guess I'd use the term performance, in terms of due diligence, in terms of, going from introducing the investment to then they're making the investment. How was that journey for you from beginning when you kind of stumbled into this to now? Are you still feeling that same kind of fiduciary pressure to be the best that you can be, or is it kind of, I'm just kind of used to this now?
I don't have any, and the reason is because I'm coming from that institutional type investor. It's not my money.
Right.
So I'm making decisions based upon, 90% in my mind, real estate investments are analytical. You can get numbers, you can figure out if this is a good place to buy an apartment or not because of what the number of people and their how much they make and how many units are already out there and stuff like that. So you can quantify. The 10% is your gut, right? But
okay.
There's three things that I was told at every family I've worked for, and it's don't lose money, don't lose money, don't lose money.
Yeah.
And we got to protect the downside, and that's what I'll be performance based to some degree. So it's like, look, I don't make anything if it's not a good deal. So we're on the same side of the aisle, but the average return, and you might be surprised, but what do you think the average return of a family's portfolio is?
The average return, I'm going to say 11%.
7.
7. Wow, lower than I would have thought.
Yep. If they can get a 12 on real estate, they're ecstatic. But it's 7%, and that's because you're going to have some money that you're going to grow. You want to grow different investments you want to make, but once again, you may never see that money ever again. So you have to make sure that that you're making good decisions. And it's like yourself, I'm sure. You get to a point where you've done so many deals that well, that's not good.
You already know, right?
You're like, I've seen this movie 1,000 times. I know how it could end.
100%. Yeah.
So, but that's that I include that into the gut component. That's part of your gut. I don't think so.
Yeah. There's like no algorithm for experience,
There's not, and it, that's why it's so valuable if you really know your own market, because you could say, the whole market could be terrible, but you're driving by this one building over and over again, and that would be a great place for blah, blah, blah.
Mm-hmm.
And lo and behold, yeah, it is.
Yeah. Let me shift gears with you a little bit, and let's talk opportunities. Last time we talked a little bit about opportunities. So what are you seeing out there in the market right now? There's so many different choices, and there's so many bright, shiny objects out there. Talk about what you're seeing out there and how you're kind of separating the good from the good from the not so good. With you using a lot of that experience that we're talking about.
Well, there's two ways. One is, and I know you do multifamily, you're involved in multifamily, but we did one workforce housing deal that we're in right now, but that's different because those are 400 square foot modular homes in a mobile home park community.
Mm-hmm.
But we haven't done any actual apartments. It just didn't make sense to us. And there's $4 trillion that are coming due of debt. A lot of people didn't make great decisions in 21, 22. So it's creating a lot of opportunity where you can find discounts of 20 to 45% on certain multifamily.
Yeah.
And the demand is still there. The demand's not going anywhere. And we're also going to be seeing more and more a decrease in development that's happening, which means that there'll be that the demand is going to continue on, but there won't be enough supply, right? And the banks kick the can down the road a little bit, but we're starting to see it now. The best discount we've seen was 45%, and in a cash flowing asset. And so multifamily is the number one area. And then because we should be able to pick up some stuff at discounts. And then second, there's a couple of types of industrial that we really like.
Interesting. When you're talking 45%, are you talking 45% from the value? You're talking about 45% from maybe what the loan balances are?
45% from what the value was.
Okay.
Right.
Okay.
So
Yeah.
it was, because what's happening, unfortunately, is people bought something at 30 million and now it's worth 20 million. Well, they could have 21 million, 22 million of debt. So they have to walk away from the equity. The biggest, I had a friend of mine call me and he walked away from 24 million because he didn't want to have a personal guarantee on a loan.
Wow.
And the biggest that we've seen is 100 million that somebody was going to walk away from a portfolio of equity.
Wow.
And we're a little bit different. We're what's called allocators. So we operate like institutions like a Goldman, Blackstone, where we identify best in class people like yourself that we'll give 90, 95% of the capital to. And you're doing all the day-to-day stuff and we're overseeing, helping try to make, maybe there's some decisions or, being able to look over something that maybe you miss because you're in it every day instead of, being able to take a step back.
Mm-hmm.
And what that does for us is it increases our deal flow too. So let's say we have 10 partners. Each partner looks at 2,000 deals a year. They might only take 5 or 6 deals, right? And with 10 partners that are doing 2,000, that's 20,000 deals that basically are being reviewed, and we only have to choose 4 or 5. So that's another way we mitigate our risk is working with good people like yourself to help identify, those opportunities.
Yeah. I was I was in Scottsdale a little bit over a month ago, and a gentleman comes. I started talking to this gentleman, and he owns a pretty big real estate brokerage that extends Oklahoma, Texas, that area. And he's talking about how much of a stack of broker opinion of values that his team has to get through on behalf of, not only conventional traditional banks, but also agency lenders too. And he proceeded to tell me that just in Texas alone, there are over 300,000 units where the owners are having to reach into their pocket to pay their debt service.
Yeah.
Yeah, the properties are cash flowing enough.
That's right. Or they're doing capital calls going back to investors, and they're saying, hey, you got to put in some more money because we don't have enough. And that's one of the things I try to explain to people. I'm like, look, you don't know cap rates and whatnot. Think of it this way. Cap rate is what you could expect the income. So let's say you bought it at 5 and you're getting a 5% on your money, right?
Mm-hmm.
So for $100, you get $5. Well, let's say your debt, it was at 4%. So you make 5, you have to pay 4. Well, you have $1 profit. Well, what happens when this loan goes away and now you have debt for $6? You make 5, but you have 6.
Mm-hmm.
You can't make that payment. And that's, and that's with the interest rates and stuff like that, which is how it happened. And, it's as simple as that. For exactly what you said, owners having to reach in, going back to investors to say we need more money, that type of thing. And a lot of those people are hoping. They're just like, I just have to survive until interest rates go back down.
Right. Yeah.
Well, that could take 2-3 years.
Yeah.
And so
that's if they go down. That's if they go down.
That's right. That's right.
There's no guarantee they won't go the other way, right?
That's right. But that creates opportunity, right? That creates opportunity. And once again, the fundamentals are still there. The demand is still there. So as long as you focus on the fundamentals, then you're okay from that perspective. Yeah,
for sure. And one of the things that I learned there too was because when most people think about a property in distress, you got pictures in your mind about what that property looks like, the condition of it and those kinds of things. And I'm used to seeing those kinds of distressed properties. So that's nothing new. That's really nothing new.
This is financial distress.
Yeah, this is a much different deal because you've got, you're going to finish my sentences for me, but you got properties that are that are in good shape, good condition, well located. They're having problems.
That's right, and some of them have already been fixed up because they were in bad shape initially with what people think. Well, now they're good. They just don't make enough money to pay the debt.
Yeah.
Yeah. And so that is, cycles, real estate cycles run in 18.5-year cycles. And you can go back 200 years in the US, the UK, and Australia. And I could show you a chart that shows you that it's spot on. And I've been saying for 6-7 years publicly that we're going to go into a recession around 2026. Well, that's where we're at. And we're halfway through the year, and we're going to start seeing more and more opportunities than what we're seeing now. And, that'll last for probably 18 months, 2 years, and then we'll start seeing things come back around. But that's it's interesting because one of the things that we would ask some of our partners that we allocate to, I'll be like, so were you around during the last recession? They say yes. I ask them, how many properties did you give back to the bank, right? I can't just take the property. I can't. So they'll give me a number or they'll say none. Well, either way, what I say is, what did you learn from that? Because it's okay that you gave properties back. A lot of people gave properties back. The question is what did you learn from it? And what are you doing differently now that you weren't doing then? And everybody's made money since 2012, everybody. And so a lot of people have not seen what we're seeing with the interest rates and all this other stuff. And it's very easy just to hop on the train and keep going. But at some point in time, the train is going to come to a halt. And, one of the things that I learned when I started back in 2003 was, as long as you're cash flowing, doesn't matter if the property's worth zero, because you can pay the bills, it's positive, and you can just ride it until things come back around.
Yeah.
And, that comes back to how much debt you put on the property.
Yep.
And once you start seeing mezz debt, preferred equity, that's a huge red flag.
Yeah.
Huge red flag, because people are trying to make up the gap.
Yeah.
And your blended rate goes high, very high.
It was around 2021. I'm sitting in a room with let's just say a bunch of guys like me, sitting in a room, and we're having discussions. And a lot of the discussions that other guys were having was a little bit of sticking their chest out, talking about how great of a job they've done in obtaining their capital stack or their financing. So they would get, for example, a 75% loan to value from somewhere, then they'd get bridge financing or mezzanine financing, so they're really maybe into these properties with 5 or 10% really out of pocket, and the rest is pretty much borrowed, and they're feeling really good about that because, of course, in their mind they think everything's going to continue to go up, and obviously when you use more leverage, you've got the possibility of really increasing return. And so I stood up and I kind of acted like Uncle Darren from Iowa. So I said, guys, how many of you went through any problems or issues in, let's say, 2007 through 2010? How many of you guys did? Raise your hand. DJ, none of them raised their hand. None of them. And I said, guys, you guys got to be thinking about how much more leverage you're going to be putting on these properties moving forward, because you're really putting yourself in a bad position. Well, they didn't like that. They didn't like that at all. And I actually had a couple of people after I had that to say to them, say, why are you bringing us down, man? Why are you bringing the mood down? Why are you doing that? And I said, because the way that you guys have this outlined with the amount of debt that you're getting, especially floating rate debt, and thinking that you're going to continue to raise rents 15 to 20% a year, it's just not realistic. It's just not realistic. And so when we're seeing things like we are today, I've got the gift of, we talked about it before, I got the gift of experience. We've seen this movie before, kind of thing. And yeah, so a lot of those guys that were having those conversations with me, they're now having very different conversations. Very different.
I mean, it's in some ways, the first thing that I would think of would be good, because there's my opportunity. That's good.
Yeah.
Right. And every time somebody does something that's not the best, somebody else benefits from it. And that's exactly what that would be. And it's inevitable. I mean, when you look at the cycle, it's pretty funny, because when you're coming out of recession, banks haven't been lending, development has stopped. So the demand goes on, but now you don't have enough product. So then you start having development happen, and eventually you start getting lenders that start lending at higher rates, and then things start moving, and values start going up, and people start feeling more comfortable, and they feel good about everything. And then a developer, they're in the business of developing. So let's build as much as we can, as fast as we can, and make as much as we can. And then, banks will start getting a little nervous. Then they start lowering what they're going to give you for the loan to value. And so then you get other companies that come in and say, I'll make up the gap for you. Just pay me 11% and 12%, 13%. And now all of a sudden you're, what's going to happen next? Well, things start slowing down, and then you have too much inventory, and then then it just starts all over again. And it just keeps happening. I mean, it's like we're not smart enough to we keep making the same mistakes, but that's exactly what happens.
Yeah. Now you were talking about some other areas of opportunity. I think you're looking at it. Did you mention industrial? Did you mention that? What do you see in there?
There's a couple different areas. We identified cold storage a couple years ago that we felt was a really good place. Outdoor storage, where might be, where people might keep their trucks, or, drivers, stuff like that outside.
Is that literally just paying for a parking space? Is that literally what that is?
Yeah.
Okay. All right.
That's what you're doing.
Yeah.
Then small bay. I really like small bay. And small bay, I think, it's where you might rent 5,000 to 20,000 square feet. So think of that person that furnishes houses when they go to sell. They need furniture to make it look good. Well, in between houses, where do they put that furniture? They got to have somewhere because they own probably, 100 chairs and they're only using 60 of them at the time. Well, you got to have somewhere to put it. So they might rent 10,000 square feet, 5,000 square feet to keep their stuff. So that's small bay. So you could have 20, 25 tenants in there. And they did fine during COVID. They're usually close to the city. And 70% are owned by mom and pop.
Mm-hmm. Yeah, that
So-
doesn't surprise me.
So to me, it's where self-storage was about 15 years ago.
Mm-hmm.
And so that creates, a big opportunity. And depending on what the zoning's like, you might even be able to get it rezoned if you had to for multifamily or something, if there was that big of a demand. So
Right.
small bay, really, really like small bay.
Interesting. When I got maybe one or two more questions for you. When you're thinking about, what we just discussed, but you also mentioned that you think that there's a really good chance that we're going to be seeing some recessionary climate here in the near future.
Mhm.
How does that change the conversations you're having with with your partners, with investors, with family offices? How does that change the conversation? Are you more of a patient, let's be patient and kind of wait for the opportunity? Are you feeling kind of more aggressively, getting on it, some certain things? What kind of conversations are you having with that in mind?
Yeah. So what happened at the last recession is that families waited until things started coming up. So they really missed a lot of that growth. That's why 6 years ago or so, I started talking about it, because I'm like, it's coming. You better be ready for it. So the conversations today is like, we're going to have a window, guys. We got about 18 months. Now, this is when the real money gets made. This is it right now. These are hard assets. These are good assets. They're financially distressed, like you brought up. And so now is the time. And, my first patriarch in Colorado, during the last recession, he grew his portfolio from 150 million to 450 million in a matter of like 2 years, because the discounts and everything that's available.
Interesting. Well, let me wrap this up by asking you. First of all, I appreciate your time in joining me today. This has been fantastic. The information's been great. My last question would be, what question do you think I should be asking you about, or asking you that I'm not asking you? Is there a question that you're thinking I should be asking you about, maybe your work with, with family offices, the Family Office Real Estate Investment Institute, whether it's Evergreen Property Partners? What question should I be asking you that I haven't asked you yet?
That's a good question. I would say, I don't know if you're still on here or not, but I would say, how much time do I have to take advantage of this downturn in the market? And I would tell you 18 to 24 months. So now's the time. So that'd be it. Hope that helps. Thanks for having me. It's been a pleasure once again, as always, Darren. And, happy investing.
If you want to get your hands on more great multifamily real estate content, make sure you click here. If you want to invest passively in great multifamily real estate, make sure you click here.